Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for August 2nd, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, and I'm joined by Dean Croak, who's our Principal Industry Analyst. Good morning, Dean.
Hey, Ken. How's it going in sunny Florida?
It is delightful. I think we're going to have another 90-degree, sunny, breezy day here on Anna Maria Island. I got my beach apparel. I'm ready to roll.
Good for you. We're glad you stepped away from vacation to join the show.
Well, it's just a testament to my absolute dedication to both freight analytics and DAT,
Yep. You're the man.
Just nonstop, all the time, thinking about freight.
Yeah.
But for those new to the show, we're here every Tuesday morning talking about freight, trends we're seeing in the market, data, but most importantly, answering your questions. And last week we had more questions than we could ever answer, so let's keep that trend up. And send in those questions. You can drop them in the chat below, and we will get to them at the end of the show. But given that we have a lot to cover, I'm going to jump right into our key trends of the week. So diesel continues to trend downward. EIA came out last night, continuing to push diesel prices down. As we've been talking about for months, that will have a natural inflationary effect on base spot rates, and that's what happened. Even though spot market capacity did tighten a bit last week. Van and reefer replacement contract rates remain negative, indicating a turning market, which again is exactly what we expect as contracts come up for rebid. They are being rebid in a looser capacity environment than when they were signed 1 to 12 months ago. Big story out west is port congestion. We'll talk a little bit more about that towards the end of the show, but Union Pacific and BNSF metering outbound ocean container volumes. And then continuing on that trend, Port of Oakland sues the carriers protesting AB 5. I'm sure Dean will cover all of that in his market update right now. Take it away, Dean.
Ken, so yes, end of month shipping volumes did increase last week. Volumes are up on our load posts by about 13%. Capacity did tighten slightly. Load post volumes are still over 1 million loads per week, so still seeing a very healthy spot market. About 6% lower than this time in 2020 for perspective. So as a result of higher load posts and 8% fewer equipment posts last week, the load to truck ratio increased to 4.05. In the refrigerated category, load post volumes are also up by about 17% last week, still 5% below 2020 levels for the end of July, but still 37% lower than this time last year. But it's no surprise, of course, that reefer demand did increase slightly last week. We've had a huge heat wave across the country. We had fewer carriers posting their equipment due to the higher volumes. As a result, the load to truck ratio increased by about 25% to 7.48 loads per truck. And in flatbed, there was very little change in load post volumes last week, although they remained 39% lower than this time last year. Compared to the strong flatbed markets in 2018 and 2020, load post volumes are 6% and 4% lower, respectively. Flatbed equipment posts remain at record highs for this time of the year and are even 55% higher than this time in 2018. As a result of all that activity, the load to truck ratio decreased by about 3% to 19.59. So having a look at our market condition index across the country, as Ken alluded to, in a repeat of last summer's events in Los Angeles, where BNSF and UP started metering the ocean containers on the outbound side, particularly Los Angeles and Long Beach. The blame is being pointed at shippers' inability to retrieve containers from inland ramps and returning chassis fast enough to create additional room for cargo as the primary reason for decreasing intermodal capacity on the West Coast, according to an article by Ari Ash in the JOC. And as was the case last year, truckload capacity follows that congestion. It tightened last week as soon as shippers switched to the truckload sector to move volumes on crucial lanes such as Los Angeles to Chicago. About 30% of intermodal moves occur on that single lane. On the DAT network, spot rates from Los Angeles to Chicago were up last week. They've been going up for a few weeks now. They're up to $1.84. It's up 17 cents a mile in the last month. But for context, that's still 87 cents a mile lower than this time last year. The other lane where they're metering outbound containers due to the congestion inland is Los Angeles, Dallas. Rates are up 7 cents a mile in the last month, but still $1.31 lower than this time last year. Having a quick look at the Southeast market, spot rates in Atlanta continue to drop. Last week they were down 3 cents a mile to an average outbound rate of 201. Remember, that's line haul spot rates excluding fuel. Further north in Elizabeth, New Jersey, capacity continues to tighten. Spot rates are up for the fourth week in a row to $1.78 per mile, following last week's 2-cent per mile decrease. Elizabeth to Chicago, rates are up 5 cents a mile to an average of $1.48 in the last month, while loads to Atlanta were also up by 3 cents to $1.57. Part of the increasing volume story in Elizabeth, New Jersey relates to the imports that are coming into the Port Authority of New York and New Jersey. Cargo volumes in the port are up 41% in June compared to June 2019. So lots more volume coming into the Northeast. Having a look at the refrigerated market, we took a look at some USDA data last week. National weekly truckload volumes are down close to 10% compared to the previous 2 years for the end of July. Mexico imports are well past their April-May peak each year and are running about 3% lower at the end of July. Volumes from Canada are up about 5%, although they represent a much smaller percentage of the total volume. The USDA reported a shortage of trucks in the Southwest Indiana market, Evansville. Lots of shortage of trucks for watermelons and cantaloupes last week. Spot rates in that market increased 4 cents a mile to an average of $2.91. Evansville to Orlando at $2.99 per mile, increased by almost 50 cents a mile in the last 4 weeks. And having a look at the market on the West Coast in Fresno, reefer line haul rates continue to cool following last week's 4-cent per mile decrease to $2.33. Further south in San Diego, a much smaller market, but it's a heavily dominated market by reefer imports from South America. Reefer rates increased in San Diego by 3 cents a mile to an outbound average of $2.84. And following a week of trucker protests in Oakland, California, load post volumes were up 7% last week, although capacity continues to loosen, with spot rates in Oakland down for the fourth week in a row at $2.28. Having a look at Jacksonville, last week spot rates jumped 20 cents a mile to an outbound average of $2.30. Reefer capacity was also tight in Miami, with rates up 7 cents a mile to $1.29 for northbound loads. And a capacity, extremely tight capacity last week in Pittsburgh, 22% increase in load post volumes. Rates are up to $3.76. Pittsburgh to Orlando were also up, increasing by about 70 cents per mile to $2.44. But that's about exactly where they were this time last year. And having a look at our flatbed market condition index, have a quick look at the steel producing market in Gary, Indiana. It's one of the largest in the country. Spot rates average $3.17 a mile. Short haul loads east to Detroit were paying about 5 cents per mile less at $3.84 compared to this time last month. That's about 42 cents per mile lower than this time last year. And even though load post volumes were down for the third week in a row in Houston, capacity continues to tighten for the third week in a row also. Last week, rates were up 6 cents a mile to $3.03 on the really busy lane north to Houston. Loads north to Fort Worth were up 9 cents a mile over the same time frame, averaging $3.98. That's about 66 cents a mile higher than this time last year. And in San Diego, flatbed line haul rates jumped 20 cents a mile to $2.43 following the prior week's 35% increase in outbound load post volumes. A lot of the increased volume you can attach to a lot of the break bulk ships that bring in steel into the San Diego market. And wrapping up with our year-over-year look at spot rates, exactly as Ken predicted last week, falling diesel prices have increased dry van spot rates by just under a penny per mile compared to the previous week. In case you missed it, last night the EIA reported a 13-cent drop in the national average of ULSD prices to $5.14 a gallon. That's down 67 cents, in 6 weeks. The national average line haul rate for dry van stands at $1.96 excluding fuel, and compared to DAT's top 50 lanes, spot rates are still 40 cents per mile higher than last week's national average. They're about 43 cents per mile lower than this time last year, but still about 35 cents per mile higher than the pre-pandemic average for last week. And refrigerated, last week's reefer line haul rate increased by just over a penny per mile to a national average of $2.38. Reefer spot rates are still 54 cents a mile lower than this time last year, but about 32 cents a mile higher than the pre-pandemic average. They're also about 8 cents a mile higher than the same week in 2020 for some extra context. And lastly, flatbed line haul rates have dropped by 22 cents a mile so far this year, but 19 cents a mile of that is in the last 9 weeks, following last week's 2 cent per mile decrease. So a lot of cooling off in the flatbed market in just over the last 2 months. The national average rate ended last week at $2.46. That's 23 cents per mile lower year over year, and about 8 cents per mile higher, though, than this time in 2018. So that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. And with that, it's over to Ken for the short-term forecast.
Thank you, Dean. So just to refresh everyone's memory here, the blue line is the historical rolling 7-day rate per mile. This first chart is for dry vans. This excludes fuel. And then on this chart, it's a little difficult to see because it's all mashed together, but the green line is ratecast, the red line is our short-term forecast, and then the two others, the gray and the yellow, are blends of the two forecasts. So what I think you can take away from this dry van chart is that the forecasts are in relative agreement through middle of August, pretty much a holding pattern, which, as we've said week over week here, is projecting strength, right? In a seasonally slow period, if rates do hold steady, seasonally adjusted, that would mean kind of rates are up, even though they're not up. But I think fuel is the main thing pushing against seasonality here. This will be a trend you'll see in all the forecasts, but once we get into that true back to school period, end of August leading into Labor Day, that's projecting strength in the forecast, pretty much in unison. Ratecast is a little more optimistic. The short-term forecast is optimistic, but not quite as much. I will caution everyone, though, these are pretty narrow trading bands. That if you look at that y-axis, it's pretty zoomed in, right? We're talking about a 10 to 15 cent trading window between $1.95 and $2.15. So just keep that in mind. These are minute details. I'm going to move on to reefer. Very similar story with probably even more model agreement. Maybe a bit of a wider trading window, maybe 20 cents. But in this scenario, it's projecting short-term spot rates to get into that 230 range on the high end by the end of August, which I think is a pretty reasonable forecast, especially if fuel prices continue to fall. I'm going to finish with flatbed because I think this one's probably the most controversial. Forecasts are very closely in agreement again through the middle of August, but I do think what you're seeing is some I don't want to say unfounded because it's the model's clearly picking up on something, but I would caution folks, again, it's a narrow trading window, especially for flatbeds, but some of this optimism, it's sort of thinking we're going to pull out of this slide, right? Because if you go back, if you trace that blue line further back, it's been quite the slide pretty much since what, Dean, hop on it a bit and talk about it, probably since the 4th of July, but the models are predicting us to pull out of it a bit starting about the middle of August. So we'll see. These aren't crazy numbers. This isn't like going from 250 to 275 or 280 by the end of the forecast window. So again, something to keep in mind, but I would caveat the flatbed forecast a little bit with there's some big unknowns around housing starts and industrial production. But with that, I'm going to move to our question of the week. And as I alluded to earlier, that question is related to West Coast ports. So now that railroads are metering ocean containers in LAX, will we see a repeat of the tight truckload capacity on key intermodal lanes impacted by inland congestion? And who better to answer that than Dean?
Yeah, Ken, it's been a fascinating story. We saw volumes on that heavy intermodal lane between Los Angeles and Chicago. Remember, about 30% of intermodal moves travel on that one lane. It's a really competitive lane with truckload. The volume of loads moving on that lane alone are up 16% since the start of June. Rates are up about 4 cents per mile. Rates are still way lower than this time last year on that lane at $1.84. As we covered earlier in the show, they're still about 87 cents per mile lower than where they were this time last year when import volumes were surging. But to put all that into context, we're seeing a lot more volume move on that one lane compared to pre-pandemic volumes where it was pretty flat. Volumes this week are triple where the volumes were pre-pandemic on Los Angeles, Chicago. So we're still seeing a lot more volume move on that lane, even though volumes are sort of down compared to this time last year. But the one trend I am noticing that is very, very strong, that as congestion builds and import volumes ebb and flow, we see that volume flow over to the spot market. And as volumes have increased in the last few months, we're seeing that trickle over again. Every time the intermodal network starts to get tight in terms of capacity for a variety of reasons, whether it's inland congestion, as is being reported today, as a result of shippers not unloading containers quick enough and chassis turn times sort of blowing out to unrealistic levels, we see shippers move volume to the truckload market. And that trend has started to become evident in the last 4 to 5 weeks in particular. The other lane that BNSF and UP are metering outbound loads out of Los Angeles to match the capacity inland is Dallas. Spot rates on that lane on the truckload side are up 7 cents a mile in the last month, but still $1.31 lower at $2 a mile. Loads moved in the DAT network on that one lane are up 86% since before the pandemic and up about 21% since the start of June. So we are already starting to see that on key intermodal lanes out of the West Coast, we're actually seeing a repeat of what we saw last year. Last year, of course, it was a lot to do with labour shortages and people's inability to unload containers at warehouses. This year, it's a space issue. And in the JOC article, Ari wrote that both railroads, BNSF and UP, have said cargo owners must stop using containers, chassis and rail terminals as mobile warehousing. Not a new story, because we saw exactly that in the truckload market last year with some of the large truckload carriers issuing detention charges to shippers. So last year it was a labour issue. This year it's a space issue on the inland side, and it's slowing down the movement of containers further inland. So that's going to have an impact on the Los Angeles market. We continue to see volatility there. I think we'll see the same on the East Coast in Savannah and ports like Norfolk and Charleston.
Yeah, I mean, this is when you would expect a lot of that, certainly the back to school, but my guess is you're starting to see a lot of the retail stuff for this fall come across the ocean, right? So I think it's
Correct.
Just getting out ahead of a potential problem.
Yep.
And again, it's exactly what we've been talking about and other people in the industry have been talking about, where make no mistake, it's not like you're going to be able to tiptoe freight from Southeast Asia to a warehouse in Chicagoland easily this year. Like, don't be fooled by the headlines that like ocean, drayage, intermodal, truckload, and warehouse capacity are just incredibly abundant, because it's just not true.
Right.
And I think if you read a lot of the especially the mainstream headlines about retail inventory, again, I just think that's such a narrow slice of what's actually happening out there. They make it seem like Walmart's not going to be bringing any freight in for fall retail peak.
Right.
And it's just not true. I mean, I can't speak to Walmart specifically, but these big retailers are going to be bringing, right? You have the seasonal SKUs that come in, like the Halloween. I imagine most of the Halloween stuff's already here, but certainly Thanksgiving and Christmas stuff, by and large, hasn't come across yet. So it's going to be something, and you have the looming labor issues, right? And the regulatory issues with AB5.
Correct. Yeah, they're all things to watch on the West Coast, and I think shippers were already aware of some of the potential downside on the West Coast and started rerouting a lot of that volume to ports other than Los Angeles and Long Beach. We were seeing that probably for the last 7 or 8 months, increased volumes around Houston. Jacksonville's going to be another big port to watch, I think, as shippers start to look for ports with better ability to have higher throughput volumes. I think for truckload carriers, we've been saying this for a year now, Ken, keep an eye on ports that you might not normally keep an eye on. So ports, smaller ports where bigger vessels can come in because they've been deepening the ports and putting more infrastructure, such as ship-to-shore cranes. It's pushing more volume into ports that you might not normally think about. And even in the ports that you do think about, there'll be volatility around congestion and surging volumes for the rest of this year.
Well, I mean, it's evidenced by some of the stuff you shared last week with the backlogs and you talked about this morning, the backlogs off New York, New Jersey, the backlogs off Savannah,
right,
in Charleston. So, I mean, these retailers especially that are moving freight around, they're not stupid, right? They're they're going to get out ahead of these problems.
Right.
Like
Right.
they weren't. I would like to believe, and I do believe that the last couple of years when they've been in this bind, it wasn't for lack of know-how or technical expertise in the supply chain. It was just they were unable to make. Like I do think the difference this year will be there are going to be ways to make it happen, and they're pulling those levers as we speak. It's been a quiet tropical. I mean, where I'm at, knock on wood, it's been a very quiet tropical season.
Right.
Um, a lot of the issues they've been facing is regulatory and labor related. So,
right.
I mean, I do think the most likely outcome this fall is a high volume peak season. Wouldn't you agree?
Yeah, absolutely. I think it'll be certainly earlier than we normally see, Ken. I think the retailers that we've been talking to on our shipper side are talking about having a lot of that back to school and shortly thereafter inventory already in stores. So they're more concerned now about making sure they get that volume in sooner than later.
Yeah, I'm not surprised. And again, it's one of those things where you gotta get into the data a bit. I mean, I'm a bit biased, of course. I think you should get into the data, but you need to get into the data a bit to understand what's happening. Because if you just pop open the Wall Street Journal or New York Times, you're not going to get a fully baked understanding of what's happening in the supply chain. I do think it helps to provide context for sure. I mean, we all read those articles and we read those sources for sure. But if you're a practitioner in the supply chain, I think it would benefit you to look at some of the data. And some of it's freely available, right? The LA Long Beach does a really great job of providing port statistics.
Yep.
As do many other modern heavy traffic ports.
Right. The on this week's Freightvine podcast, it's a really good listen to get some context around exactly this. Dr. Kaplis had Philip West and Mark Purdy from General Mills on the Freightvine podcast right before the pandemic. And this is the first time he's had them on since then. So this will be it's a really good listen to talk to one of the big shippers about what they've been able to see and do and adjust over the last 2 years of the pandemic. That'd be a really good data point to get hold of.
Yeah. It seems like a lot of our listeners are on vacation today too, because we're not getting a ton of questions. Right. I don't know if it's our YouTube issue or what, but doesn't seem like we're getting a ton of questions. Yeah. What are you going to be watching this week, Dean, from a data perspective? What GDP was big last week, right? So what's going to be the big thing you're interested in this week?
We're taking a deep dive into July's steel numbers this week from our partner at Standard & Poor's Platts. The July numbers are out. Very anxious to see what steel production raw tonnage looks like. That drives a lot of freight for different sectors, but mostly the flatbed market. I'll be very anxious to see what those numbers compare to both year over year, year to date, and particularly back to 2018 to see what those volumes look like.
Yeah, I'm going to keep an eye. I mean, I'm mostly going to be keeping an eye on margaritas and pina coladas, but I'm going to keep an eye on the earnings releases. It was so fascinating to read.
Right.
I think last week was C.H. Robinson, Covenant, Schneider last week.
Yep.
And they're just not, I mean, in conflict with what you would expect from the data, right? I mean, you would expect contract rates to come down a bit, especially given where spot rates are. But what you're hearing in a lot of these public analyst research calls, the investor calls, is that they're not conceding price. They're not rebidding. I mean, and again, these are the big ones. If you're a publicly traded carrier, you're one of a very select few, and you have pricing power to not concede. But I do think, while that might not be an absolute measure of where the market's headed, it certainly helps indicate where the wind's blowing in terms of market conditions.
So, Ken, I spoke to one of the largest refrigerated carriers last week at the Truckload Carriers Association Refrigerated Conference, and he made a really interesting statement to the audience after I said that we'd seen, reefer contracts rates peak and show some signs that they were decreasing. And he said we're not seeing it for a couple of reasons. One is we're holding very firm on our contract rates because of this. And he said very simply, drivers are making more money than they've ever made. They want to be home more often than they've ever been at home. And our driver availability numbers are really low. So we said we've actually got very tight capacity to move loads because of our driver supply issue, but not because we can't find drivers. It's because drivers are doing really well, and we want them to do that. So he said, when we're talking to our shippers, most of our shippers, we are holding firm on our rates. We aren't dropping our rates because our operating costs are so much higher these days. We can't claw back those benefits we've been giving drivers. And I think if you read some of the earnings calls, that's been a very similar theme that the large truckload carriers have been reporting.
Yeah, I mean, it's a big distribution, right? I mean, you have your owner operator on one side of the tail, and you have these massive publicly traded fleets with tens of thousands of power,
Right.
And I do think you're on the smaller carrier side, the ones that do have contract freight, there's definitely a higher willingness to concede on price when they might be much more exposed to the spot market, right?
Right.
They might be not on a fuel recapture program for all of their freight. I mean, there's a litany of reasons why they might be willing to, especially when they're maybe at, I don't know, $2 a mile in the spot market, and they have some contracts or some dedicated lanes at 280. It might make sense for them to keep that lane to come down to 270, 260.
Yep.
And again, that's all hypothetical. I'm just giving you an example. But whereas the big ones might say, look, you're getting the service that you haven't had in the past couple of years because I'm able to provide you the service. I'm certainly not, to get this service, I had to pay my drivers more. I had to reinvest in new equipment. I had to blah, 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 blah. And for all of those reasons, I'm not going to give you a concession on the agreement. Right. Now, when that contract gets rebid, the shipper might have more pricing power, but I don't see any appetite for out of cycle wholesale price decreases. Right. I do think you're going to see kind of wildcatting depending on, if you went invested in like specialty equipment on a lane and you're the only carrier on that lane, I mean, it works both ways. You have pricing power in hot markets, but in the slow markets, the shipper might know that you bought the 102 or 103 inch tall trailers, or whatever those things are. Right. And you want to keep them busy.
Yep.
We do have one question.
Yeah.
Do we think we have hit the floor related to spot driving pricing?
Interesting. It's kind of interesting, isn't it, Ken? I did some numbers on the fuel prices today in my spreadsheet. That same truck that I've been running for a year, operating costs this time a year ago were $1.76. Today it's at $2.03. It's interesting that with line haul rates where they are right now, my fuel prices have dropped from 82 cents per mile to about 79 cents per mile right now. So there's some relief on the operating cost side, but at all-in costs of $2.03 a mile for an owner-operator in a dry van, we're not far off where spot rates are right now. I mean, we kind of theorized that there might have been a new floor price a few months ago at around what it costs to run a truck. So I think that's probably more to do, though, with diesel prices dropping. But that we're certainly around that number right now, what it costs to run an owner-operator type truck.
I mean, the calendar is so important in freight, right? I mean, I think extreme short term we're up off the bottom, right? I mean, how far up are we up off the bottom? We're I don't know, 4 or 5 cents off the absolute short-term bottom that we experienced. Could they slide a little bit heading into, post Labor Day? You have extreme seasonal upward pressure, right? So I don't know that you're going to get too much of a lull before things head into the fall. And if we have any kind of labor disruption, any kind of intermodal problems, any kind of tropical weather, all of those things create upside. Certainly not downside. So there's a lot more reasons for rates to go up than there are for them to go down right now, is I guess the overall point. Again, I mean, pointing to like wholesale, like these huge broad economic numbers to try to draw conclusions in freight is, I think, a fool's errand. I don't know that the GDP number has much to do with spot rates over the next 3 months. So we'll see. I mean, my thinking is, we've hit probably a short-term relative floor, plus or minus 5 or so cents. And I do think we have quite a bit of upside. Now, full disclosure, right? When you're talking about upside, you're talking about a bet that may or may not materialize, right? Do I think it's a safe bet that the Tampa Bay Buccaneers are going to make the playoffs this year? Yeah. But if Tom Brady gets injured, it's not going to happen, probably, right? I'm in Tampa, so I had to pull the local reference, even though I'm a Steeler fan.
Good for you.
But we'll see. I mean, Again, that's my answer, and I'm sticking to it. Anything to add, Dean? I'm going to wrap us up.
No,
Plugs.
I'm good. Shout outs this week. If you've got a second, I'll be on Sales Chatter tomorrow with Dan and DJ at 9 a.m. Eastern. Connect with them on LinkedIn. I'll also be on Landline Now at 7 p.m. Eastern tomorrow night, Road Dog Radio Channel 146. Also on with Dan Ronan this weekend on Transport Topics Radio between 1 and 3 p.m. this coming Saturday, again on Channel 146. And don't forget to catch the Freightvine podcast with the guys from General Mills that's out now.
Awesome. I'm going to wrap us up. I got a cold Corona calling my name by the pool. It was really great to check in with everyone this week, and I look forward to be back in Ohio for our show next week. Bye, everyone.
Thanks.